Alright guys, so I think it's Thursday, isn't it? It's bloody cold, I know that. Losing track of the days. No, it's Wednesday. It is actually Wednesday. But I was thinking how to make the channel a bit more interesting, because obviously my updates are a bit slow at the moment because of not a lot going on. But yesterday I decided to do something a little bit different. I opened a trading 212 account, which some of you may be familiar with, some of you won't. But I thought, you know what, I'll show you some of the trading stuff, which isn't complicated. A lot of it is luck, and you'll get people say how they magically did this or magically. A lot of it is luck in trading. It's not gambling, because most of the time, as long as you're picking sensible stocks, shares, bonds, mixed portfolio, your risks are edged and reduced. So I will say, I'm not your financial advisor. I am not taking responsibility for any of you people that lose your own money. We're adults in the room. So yesterday I put £100 in a mixed Vanguard global account, because I've got ISA funds available, because in the UK we have this thing with ISA, which I believe is independent saving or individual savings account, which is tax free, and you get about £20,000 a year to invest in ISAs, in the sense of you can spend up to £20,000 a year in investments tax free. So I have other investments elsewhere, which I didn't really want to share those, to be fair, because there's a lot of money in them. So I was going to keep them separate. So this one's going to be a new trading account, and I'm going to be putting money in there regularly. So yesterday I put in 100, seen where the Vanguard funds traded. Like I said, I took a global account which is split across, I believe, about 5 or 6 different markets. So it's in the US market, Japanese market, emerging Asia markets, etc. And then last night I put another 100 in, where I actually selected more where I want to take a little bit more risk. So I used the software to set the portfolio up originally, which is less risk based, and then I turned around and put more risk in it by adding more money into some of the ones that are a bit more high risk for hopefully a better return on investment. Now I've named mine quite interestingly motorbike, because that's what the money's there for. It's going to pay for my motorbike. But in the same sense, I look at what I pay on the mortgage, I look at what I pay on for the new car in Spain for the remainder of the, I can't remember how much it is, about 8,000 left on the Ego, the little Toyota. And I will be setting up other accounts later on that are basically, if I know I've got to pay the car off in 5 years, instead of putting the extra money on the car, which the interest isn't that high, I then put it in investments instead. I'll get a better return on the investment. So it's the same with the mortgage. I'm better off in investments than the mortgage. Why? Because the mortgage is, I don't know, about 4.5%. I'd have to have a look at the minute. Maximum 6. But my investments are returning up to probably around 8 to 12% on my other account, which is obviously much higher. So the reality is, I'm better off investing it, getting it to bubble up, where I get a good return at the end of the year, because I'll just keep recycling the money in there, I won't take any out. Then I may at the end of the year go, you know what, I've made X amount of interest, let me take 1,000 of that and just hit the mortgage with that 1,000, and my accounts are still growing. The point being is, I wanted to sort of start this off something simple, start with a couple of £100 in an investment fund, and show you how quickly this can grow. Which I'm quite happy to do on a weekly basis. I'm not doing a daily basis, I'm too bloody busy, but I'll do on a weekly or monthly, but maybe even monthly, because stocks and shares go up and down daily. So my view on stocks and shares is very simple. Unless you're actually day trading or trying to scalp, where, you know, just to make a few quid here and there, then I don't think you need to update it too much, because I think this is where a lot of people actually go wrong, is they start looking at stocks when they're down and selling when they shouldn't. They should just switch the computer off and go away. Let it recover itself. Unless you're actually seeing a downturn in the market, at which point, instead of while everyone's crying and pulling money out, I actually put money in. Because I look at not that the market's fixed, but it's more a case of it's buoyant for various reasons, like things like people's shares and stuff are pensions and stuff are invested in it. The whole of market is obsessed by growth, so it doesn't mean it won't crash, because it could easily crash, but my point being, if it crashed, I'd just leave it alone till it sorts itself out. I'm not expecting it to be the end of the stock market. I mean, don't get me wrong, you may end up with some dodgy business deal somewhere that wipes the entire business off the market, but that's why you don't invest everything in one firm. You spread your risk, spread the love, or you use an index fund. I'll get into all this stuff later. But I thought it'd be a good different direction to look at, something a little bit outside all the day-to-day nonsense, the politics that we're tired of, and actually have something that's looking forward instead of back. So yeah, all right guys, well, I'll catch you later. I'm in a rush today. I've got a meeting in less than a very short time, so I've got to get to the gym and out. Thanks for watching.